Have you ever wondered what really happens before a company decides to build, say, a massive new factory or launch a product that could change the world? We're talking about billion-dollar decisions here, where one wrong move could be absolutely catastrophic. Well, it's not just a gut feeling. There's a surprisingly rigorous and honestly fascinating process behind it all, and we're going to break it down. So let's just imagine for a second we're in the boardroom. Someone pitches a huge, game-changing idea. The upside? Massive, but the risks are just as big. How do you, sitting at that table, tell the difference between a brilliant investment and a total, complete gamble?
Well, the answer comes down to a framework called project appraisal. Think of it as the strategic playbook that big companies use to vet these monster ideas. And to make this all feel a bit more real, let's follow a fictional company. We'll call them GigaCorp, as they try to decide whether to greenlight their next big thing. And you know, the first step, funnily enough, isn't even about the new idea. It's about looking inward.
Right, so before GigaCorp can even think about saying yes to a project, they first have to define what good actually looks like for them financially. They need to set a bar, a minimum rate of return that any new investment has to clear just to be considered. We call this the hurdle rate.
Now, the official term for this hurdle rate is the discount rate. And a really key concept baked into this is something called the opportunity cost of capital. All that means is that by putting $1 billion into this project, GigaCorp is giving up the chance to put it somewhere else, in another project, or even just parked in the stock market. So this new project has to promise a return that's at least as good as those other options, or it's not even worth talking about.
So, okay, how do you actually figure out what that discount rate should be? For most companies, the starting point, the default, is something called the weighted average cost of capital, or WACC for short. Yeah, it sounds a little complex, but it's really just the blended cost of all the money the company is using. See, a company gets its money from two places: lenders, who give them debt, and shareholders, who provide equity. And both of those groups expect a return on their money. The WACC just averages out the cost of satisfying everybody.
And here's basically how it works. You take what the shareholders demand, the cost of equity, and you weigh it based on how much of the company they own. Then you do the same thing for the debt, but you get to account for the fact that interest payments are tax deductible, which makes that a little cheaper. Add those two weighted numbers together, and bingo, that's your WACC. This is the baseline. For any normal, average-risk project, if it can't earn more than this, it is a hard no. But of course, there's a catch. What if GigaCorp's new idea isn't an average project? What if it's in some new, untested market, or it's using some wild experimental tech? Well, in that case, using the standard WACC is kind of like using a ruler to measure temperature. It's just the wrong tool for the job. Riskier projects demand higher returns, so we need to raise the hurdle. The real question is, how do you accurately measure that extra risk?
First, we've got to understand that not all risk is the same. You've got specific risk, which is stuff that's unique to one project, like a factory catching fire. A huge company like GigaCorp can handle that. They can diversify it away by having lots of factories. But then there's systematic risk. This is the big stuff that affects the whole market. Think recessions or massive changes in interest rates. You can't escape this stuff. And that's the crucial point. This is the kind of risk that investors demand to be paid extra for taking.
So how do we actually measure this systematic risk? We use a metric called beta. The easiest way to think about beta is as a volatility score. The overall market has a beta of 1.0. So a project with a beta of, say, 1.5 is 50% more volatile than the market. When the economy is booming, its returns will probably shoot way up. But when the economy tanks, its returns are going to fall that much harder. And for taking on that extra roller coaster ride, investors demand a higher hurdle rate.
Okay, so what gives a project a high beta? Well, it usually comes down to two main things. First is cyclicality. Think about a luxury hotel. Its success is tied directly to how well the economy is doing. Compare that to a supermarket. People need to eat in good times and bad, so it's way less cyclical. The second thing is operating leverage. This just means a project has really high fixed costs, like a gigantic factory. You have to sell a ton of stuff just to break even, which makes any dip in sales much, much riskier.
And this brings up a really critical warning. Getting this risk adjustment right is a delicate dance. If you set that hurdle rate way too high because you're scared, you might end up rejecting an incredible long-term project just because it doesn't pay off huge in year one. It's the difference between being smart and being paralyzed by short-term thinking.
All right, so we've priced the big systematic market risk into our hurdle rate, but what about all that other specific stuff we talked about? The factory fires, the supply chain problems, the political chaos. You don't just cross your fingers and hope for the best. Nope. You create a playbook to manage them head-on.
And this playbook follows 3 really simple but powerful steps. First, you identify. You get all the smart people in a room and you brainstorm absolutely everything that could possibly go wrong. Second, you analyze. Look, you can't worry about everything at once, so you figure out which risks are most likely to happen and which ones would hurt the most. And third, you mitigate. This is where you come up with an actual plan to deal with the biggest threats.
And a really handy tool for that first step, identifying risks, is the risk matrix. It just forces a structured way of thinking. You've got columns for the source of the risk, is it political, natural, economic, and rows for the stage of the project. A grid like this makes sure nothing slips through the cracks. It forces you to ask those tough questions, like what are the political risks we might face during construction? Or what about economic risks once we're up and running?
Let's make this super concrete with an example. Imagine a company, Jubiloil, wants to build a pipeline from Siberia all the way to Japan. The political risks are huge, right? What if a country on the route suddenly becomes hostile? The natural risks? That whole area is prone to earthquakes. And economic risks? Well, the price of oil is famously all over the place. This is what that risk identification process looks like in the real world.
So once you've got this giant list of all the things that could go wrong, you move to step 2, analyze. And it really just boils down to 2 simple questions for every single risk. First, what are the odds of this actually happening? And second, if it does happen, how much is it going to cost us? You literally plot these on a grid. And by doing that, GigaCorp can focus all its energy where it matters most, on the threats in that scary top right corner, the ones that are both likely and devastating.
And finally, we get to the action plan, mitigation. And this isn't just one thing, it's a whole toolkit of strategies. You could try to avoid a risk completely, maybe by just changing the project's location. You could reduce it with better safety protocols. You can transfer the risk. A classic move is to give a contractor a fixed-price contract. That way, if costs go over, it's their problem, not yours. Or you could share the risk by partnering up with another company that's better at handling that specific threat. The whole point is to take the teeth out of the biggest risks before they get a chance to bite.
So let's bring this all back to the GigaCorp boardroom. They started with just a raw idea, and now they have a deeply analyzed, risk-assessed proposal sitting in front of them. You see, this isn't about guesswork anymore. It's about making a genuinely smart bet. So here's the entire journey, in a nutshell. First, they set the bar, defining what success looks like with their basic hurdle rate, the WACC. Then, they adjusted that bar for danger, raising it with beta to properly price the project's unique market risk. And finally, they built a custom playbook to actively manage all the specific, on-the-ground risks they could find.
And really, this is the ultimate lesson here. Billion-dollar projects are never risk-free. The companies that win aren't the ones who hide from risk, because that just means hiding from opportunity. The real winners are the ones who master risk, the ones who can see it clearly, price it correctly, and manage it proactively.
So that leaves us with one last thing to think about. Whether it's in our jobs or just in our lives, we all make big bets from time to time. Now that you've seen how the pros do it, what's the hidden, systematic risk in your next big decision? And maybe more importantly, what's the right price for taking it?